Hello everyone, how's it going? In this video, we're going to be talking about AVCT. Now, AVCT has been operating in the cloud computing space, and over time, it has proven that this industry in by itself has a lot of promises and potentials for sure. For example, it is a large with a lot of users. It has very generous valuations potentially, but it's also very cash burning, expensive regarding all the costs that they have to assume. For example, the hosting, the computing, the hiring of different staff, and so on. So, regarding this industry in by whole, they do need to have a lot of capital to get the market share and to make sure that they get through the initial phase of loss. But AVCT, unfortunately, has been proven to be a small fish in the big pond. And when they went public back in 2020, it was arguably one of the worst time to go public, which, by the way, they went through a SPAC company, so a special purpose acquisition company, basically a blank check, allowing them to reverse merge with a private company in order to make it public. It's a cheaper way to IPO, essentially. And from there, we can see that it's not because it's a SPAC that it's going to be a golden goose, because the stock plummeted soon after, as March of 2020 arrived, which coincided with like the beginning of the lockdowns around the world. So the economy kind of plummeted, shareholders' expectations got spooked, and this is why the market was very bad then. Of course, as everything went up over the next 24 months, so did AVCT, but I don't think it was enough. Like, it never went back the pre-reverse merger era. And in order to raise capital, they have over time sold part of their business and also diluted the shareholders. In other words, they have sold a lot of shares. They've done all this to buy time so that by the time they've run out of their initial pot of investment, they can maybe get like a positive cash streams from their operations. Unfortunately for them, the time ran out, and now they need to sell. So the opportunity for us, the traders, is mostly the volatility from the market, the fact that there is a huge short position, and the hope that there is a rich buyer. These are the opportunities. Now, the pitfall is, in my opinion, the company itself. I mean, the financials are not in a good shape. They have little debt, but at the same time, they have sold a lot of shares in order to make sure of that. Also, they used to have more than the current business that they have, which is candy, and now they've only have candy to sell. So even if they go back and try to sell their whole business, I'm not sure how much people are willing to pay for it. Of course, let's not forget that this is also a stock that has a lot of potentials. For example, we've talked about the fact that it has a huge short position. Well, this in by itself is already a good opportunity, because we have to remember what a short is. It's basically borrowed shares from brokers that people who have those short positions have to pay a financial fee to keep it open, and that they have to close by buying back the shares. In other words, they make money as the stock plummets or tanks. This is the definition of a short. Now, what is the definition of a short squeeze? Basically, a short squeeze is when people want to force the short positions to redeem their shares. So like they have to buy back their shares. This essentially acts as an additional buy action if the stock is on a positive momentum. So this is why a short squeeze can be very powerful. It's not very predictable, and at the same time, it can be very lucrative for people who have it right. Does it really mean that the companies that have been shorted don't deserve to be shorted? I mean, from an ethical perspective, that might be so, but from a financial perspective, it's far more negotiable. If we take the examples of companies that were short squeezed and shorted before, I mean, AMC and GameStop, they're not flourishing companies. You see what I mean? Same goes for Redbox. I don't know if any of you still remember when a lot of people were talking about Redbox and how it's going to be a massive short squeeze. Well, those companies are interesting for like investors or traders because there is a potential for a lot of volatilities, upward or downward. And of course, in this case, people are hoping that it's going to go up. So this is the definition of a short squeeze. The only thing that you need here is momentum. And momentum is something that grows up like a snowball. So the more momentum you have, the more momentum you're going to keep having. So this is like the interesting part of that play. Things currently remain uncertain because in order for this company to be saved and the shares to be kept at their current value at least, there needs to be a serious buyer with a lot of cash. But this is not currently a disclosed information. And while we're doing this, in order to remain listed on a Nasdaq, they have decided to reverse split their stock, meaning, let's say there's a total circulation of 100 stocks before. A reverse split means that for every 10 shares, they become one new share. So this company now has 10 shares instead of 100 shares. And so for each and every one shareholders, they have 10 times less shares, and each individual shares are worth 10 times more. This is the avoid delisting back to the OTC market. The reason why this is relevant is because for a lot of institutional shareholders, once a company goes to the OTC market, they will dump them immediately. And because those positions may not be significant enough for those managers and institutions, they may not even know that those positions have been liquidated. So this is why they want to remain in Nasdaq. The current expectation from people is that there's going to be a lot of good news that are going to be announced. There's going to be, a rich buyer coming in who will say, I'm going to buy the shares at a premium. And this will force the shares to go up. And because the shares are up, people who have shorted this position would have to buy back the shares from the open market, which acts as another massive buy action. So this is why a lot of people want to get in to AVCT now. There's huge retail interest, and from the things of it, there also seems to be a lot of institutional owners. But here's the thing. I think that there's far more retail interest than the institutional one in reality, because a lot of the institutional owners are actually people who are shorting the stock. It's just like the way that things are presented on the website called Fintel that kind of explains why there's currently like a institutional ownership of above 100%. So right now, the price action is going down, probably as a mechanical result of the reverse split. Because other than that, I personally haven't seen any other reason that can explain why the stock is acting the way it did, right? At the same time, I would say that it's also because time is slowly running out for this company. They cannot keep waiting forever for this endeavor to occur. And at the same time, I don't think that with their operations at the level that they are, that they can really just get out of this situation by operating this company well, by having operational cash flows. I don't think that this will happen with the stock anymore, given that they have already decided to sell their business. Now, my opinion is that given the current price is still falling, I believe that a good opportunity is now. Because if we think about it, the price is already that much lower. It's not going to keep falling forever, right? So there is no news that has been announced, which suggests that any negative sentiment is been priced in. Obviously, no one can know for sure where the bottom is or when the stock is going to at least stop being sold off, right? But in my opinion, whenever this time is, it's going to be in the short-term future, because there won't be that much left the sell for, right? That this is what I think is going to happen. Like when the stock was in the $3, $4, $5, $6 levels, yeah, maybe there's enough space for like the short sellers to keep their shorts open. But now that we're already like below $2, and this is after the reverse split, I honestly don't think that we're going to see other like falling off the cliff kind of situation. On the other hand, because this is a small cap, because this is in a relatively volatile sector, and also because money is tight and it is tight for everyone, we should really be careful about how much we're willing to buy AVCT for and how many shares we're willing to buy and if we should buy them. Maybe not in that order. First, you should probably decide if you want to buy this share, and then how many shares you want to buy, and then at which price. So in terms of whether you should be buying AVCT, I believe that if you like risks, if you're comfortable, and if you have a certain track record trading penny stocks, AVCT is no longer a penny stock at the moment, but it was for some time, right? So if you're comfortable trading penny stocks, then I would say that AVCT can be something to look at. At the same time, if you believe that a buyout is actually happening, right, or it's gonna happen no matter what, then this is also a good stock to invest into. Because even though nobody has said anything about a potential buyer, there are some hints that Microsoft is at least interested in the business. It has some integration potentials with Candy. Candy was talking about how to integrate with Microsoft Teams. Like from people who used to work there, they were saying that, oh, things regarding like an international merger is being kept under a lid. So all these point to the fact that the negotiations are ongoing. I would warn against one possible scenario though, which is the following. No matter what is the kind of deal that we can get at the end, there's a possibility for winners take all. Meaning they're going to make sure that whatever money is left on the table is scooped up by the bigger players rather than the smaller ones. Like for example, if we're talking about buyout deals, ultimately they may have to sell their business at a disadvantage to a third party, say Microsoft, Amazon, or Google. Because at the end of the day, if they don't have a lot of bargain chips on their side, they might just have to take whatever price there is for whatever AVCT still has. And for that reason, I do believe that we have to be careful regarding how many shares of AVCT we want to buy. Personally, I would limit your exposure between 0.5 to 1%. This sounds reasonable for a stock of that dimension, of this kind of profile, and in the industry that it is in. And now the last one. Where are we going to buy it? I personally think that we need to wait for a support sign somewhere from here all the way down to maybe $1.25, maybe even $1. Why $1? Because it is very significant for if the stock is to remain listed on the Nasdaq, which seems to be clearly like a very important goal for the manager and the board of directors. So given all these indications, I think that we should be looking closely the price action of AVCT over the next few days in order to see if there is a certain level that the stock no longer wants to go down below, right? It could be, like I said, between $1 and $1.25. If it's higher than that, it's okay. Just try the dollar average in. Because either way, you should keep a small position now and to maintain like a rather large percentage of allocation for later purchases, in case there is a lower grind while we're still waiting to know who would be the new buyer. One of the situations that we need to be aware of is if the company cannot find anything or anyone to buy itself. In this case, we might head towards somewhere that's way lower, but by then I would say that we also need to liquidate this position because the circumstances and the assumptions with which we have entered in the position in the first place would no longer be there. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.